Swayam Prabha. Digital India. Educated India.
Today we start a new topic, topic 3. This is very important from your knowledge point of view, because tomorrow particularly economic students would often get jobs in the banks, what I am finding, and it is kind of a beginning of kind of things you like to know about Indian monetary system. The banks often deal with this kind of things that I would talk about. Indian money market, because banks are very important institutions in the Indian money market. Money supply to sab dekha hai, definitions वगैरह, velocity, kind of conceptual macroeconomic issues. These are macro plus money market related issues which is specific to say the banking sector, etc. Now, money market, what is the market? What you have seen economics, the first course that you have credited is probably the microeconomics, and in microeconomics we do talk about a market. Market, the first thing that comes to people's mind when you go to a market is this: there are some sellers who are selling something and there are some buyers who are going to buy something, and they meet and the buying and selling goes on at a price. And people have a choice in a free market. It can be a controlled market, which is a different thing. In a free market, people have a choice what to buy. If they don't like the price, they don't buy it. If they like the price, they can buy it. Another thing about market, which you must have learned in microeconomics, is that market doesn't have a geographical boundary usually. If you say automobile market, you don't see automobile market only in Kanpur and Delhi. Automobile market can be spread all over the country. Now, you can distinguish between the automobile market in Kanpur and the automobile market in Lucknow, it is a different story. But if you generally call about an automobile market where automobiles are sold, all right, it does not have a geographical boundary. In fact, if you open the economy, it can have an international boundary. The whole world, in Mars or Moon, they do not use automobiles still. So, on Earth, you can have an automobile market of the entire world you can have, and that still you can call it a market. Now, this kind of a thing is not under macroeconomics. This kind of a thing is only under industrial economics you teach, because in industrial economy you study specific markets, like a particular market, the pricing policies, the entry exit strategies, the number of firms that exist. So, you might think, sir, automobile market, is it part of macroeconomics? No, it has a macro dimension in the sense countrywide, but if you take all markets, all goods of the country, then it becomes macroeconomics. But if you pick one market where one kind of goods are sold, one kind, say automobiles, then it is part of industrial economics. It is not part of macroeconomics. So, here we have a problem. Here you may be calling this, sir, is it macro at all? Well, it has some macro relevance, but it is not macroeconomics. It has some macro relevance. It has relevance to macroeconomics from the point of view of macro policy issues, because when macro policies, particularly monetary policies, are adopted, it has relevance for this market, or the market has relevance for those policies. They matter to each other. You understand what I am saying? Like some macro policies can have relevance for industrial economics. For instance, government sets a tax, profit tax. Now, this profit tax is a general tax, it is applicable to all markets. So, when you are studying a particular industry, that tax, that macro issue is important. That can quite be true. Now, in money market, as you know, as I have already told you, it does not have a geographical boundary in that sense, and it does not deal with, it may deal with monetary instruments, but does not deal with only one. In automobile market, it does not sell only Maruti cars. In automobile market, they sell Ford, they said Hyundai, Toyota. So, the market have sub markets. You can talk about the Ford market of the automobile market in India. You can talk about the Maruti market. Again within Maruti, there are sub markets, because some people like Zen, some people like these other cars, and SX4, some people like, there can be divisions. So, what you have essentially is a structure of differentiated market. This is called differentiated products, differentiated market, which you start learning in microeconomics, carries over to industrial economics, and is very important. Now, a money market is a very differentiated market. It just does not deal with one thing called money supply. It may have relevance for money supply, but there is various instruments are there. Now, why does money market exist? What is the need? Well, why does the food market exist? We know people need food to eat, to survive. So, we go to the market buy food. Then we also can go to the luxury market. We do not need that to survive, but we go to luxury market because people have preferences for them. Similarly, in money market, people have preferences for them. Now, why do money market exist? A simple reason is, it's part of the financial system. The financial system consists of two broad markets, the money market and the capital market. Now, in the financial economics course, you would learn about capital market. In this course, you would learn about the money market. Okay. So, now, the reason why money market exists is also more or less the reason why the entire financial market exists. What are the reasons? At any point of time, this is wonderfully explained in Professor Bhole's book. I use that book, I have given reference, there is some 7-8 copies in the reserve section. Professor Bhole's book explains that very wonderfully. At any point of time, there are some deficit spending units. Deficit spending units. At any point of time, there are deficit spending units. In a country. At the same time, there are some surplus spending units. There are some deficit spending units, there are some surplus spending units. Now, these surplus units or spending units, you can even include government now in this market. You can even bring in government, although we do not talk about government part of the economic system. We talk about government, RBI, like satellites, like the moon and the stars, and the earth is here and the earth is the economy. But here you can even bring in government, because government directly intervenes or interacts with it. So, this deficit spending units and surplus spending units essentially means that somebody who is earning more than its expenditure is a surplus spending unit. It has a surplus, which we loosely call savings. And then there are deficit spending units, that is, they are spending more than what they are earning. At any point of time in an economy, you have these two groups. They may be consisting of firms, households, as well as government and other institutions. All right. Now, what the monetary system or the financial system does, just not the monetary system, the entire financial system does, is that it connects the two. You bring in banks. What do banks do? Banks, which is part of the monetary system, connects the deficit spending units with the surplus spending units. The surplus spending units take the surplus, put it in the bank, and the bank then takes that surplus and gives it to the deficit spending units. And this whole concept of buying and a whole concept of borrowing and lending, interest rate, they all emerge. All right? Why would you give your surplus to a deficit spending unit? There is a return to you. That is why you would be willing to do it. Who does that work for you? Banks do that. But just not banks do that, non-banks also do that. Non-banks also do that. All right. The same situation government may fall into. Government becomes a deficit spending unit, it will have to go to the market and borrow. Sometimes it may go to another institution like RBI and borrow. So, RBI has to have the surplus, economy has to have the surplus, but government can borrow. If economy does not have a surplus, everybody is a deficit spending unit, then government cannot borrow. Very simple. All right. So, essentially it is a very simple macroeconomic concept that if the income exceeds expenditure, you are a surplus unit. If the income is short of expenditure, expenditures are more, you become a deficit unit, then you have a problem. The problem is solved by the financial system. Both the capital market as well as the money market, what it does, they are full of what is known as full of various institutions who connect the two. Capital market में stock market में क्या होता है? Capital market, which we refer to as stock market. क्या होता है? What do you do? Somebody sells shares, somebody buys shares. What is it? Somebody who buys the shares have surplus, and somebody who sells shares doesn't have a surplus, needs money, like companies. All right, or debentures or bonds or whatever. Okay. So, like any country, the Indian financial system, therefore, I am quoting Professor Bhole's book, the Indian financial system is a complex and closely connected or interlinked system of institutions, and often institutions are there in the background, but the agents do the work on behalf of the institutions, like brokers, dealers, even life insurance companies have agents. Life insurance company does not come, you do not go to, the agents do the work. They come to your house. Since I joined IIT, they used to come to my house very regularly. These days they do not. It is an important source of income for the agents. This is a middleman who sells insurance policies to you. Life insurance people do not come. They are like licensed agents. They used to come. They used to have a license number. I remember when they used to sign my form, I used to fill it out, I buy an insurance policy, they had a license number, I remember. Even in post offices, I have seen agents, they have a license number when they sell you savings certificates. All right. So, there is a complex or interlinked connected systems of institution agents, practices, which is very important. Even a household has practices. I eat this kind of food. I sleep at a particular time. I play at a particular time. I watch this kind of movies. There are always practices. Similarly, institutions, etc., markets have practices. Like if you go to the farmers market, which is held in Kalyanpur, there is a practice of holding that market on a large scale on 2 or 3 days of the week only. I think it is Tuesday, Friday and Sunday, 3 days of a week. There is a practice, convention, all right. And therefore, it has various kinds of markets in it, the financial system. The two broad markets are money market and capital market. Then there are sub markets. Then there are transactions that go on. There are claims. When I give money to you, I have a claim on you. You are supposed to return that money to me. There are liabilities. If you borrow money from me, you have a liability towards me. I have a claim means automatically it infers that you have a liability. If a bank gives money to you, a company, bank has a claim on you and the company has a liability towards the bank. Similarly, when we keep money in the bank, we have a claim on the banks that it is my money and this is what you are supposed to do with it, and the bank has a liability towards me. So, claims and liabilities are like flip side of the coins, two sides of the coin, it is the same thing. So, this is what the financial system is all about, a bunch of institutions, agents, practices are there, conventions, etc., markets, transactions that goes on, various kinds of transactions, secondary market transaction, primary market transaction, all sorts of things, claims and liabilities. And what they are concerned about? There are three broad items they are concerned about, the financial system. The financial system is concerned about three broad systems. They are concerned about something called money, which we are trying to define right from topic 1, cash, etc. They are concerned about something called credit, which you know where it originates. Somebody lends money, like the banks can lend money to a company, credit. And also it is concerned about, which you are mostly interested, because that is where your interest lies, I have seen, not so much in money market or traditional macroeconomics people like me who have been teaching macro, etc. what your interests are, to join an investment banker, etc., is something called finance. Finance is more than credit, what you are interested in. That's why you want to study financial economics course है हम लोग का, MBA IME department में वो finance course है. Can we take that as open elective? These students often ask me. This is what interests them. I understand why, because it's a very modern thing, and finance has existed since corporate sector came into existence, and you know corporate sector what it is. The companies which are called, which write LTD at the end, which means they are limited liability companies. You know that corporate sector, limited liability companies, why they are called. It's not the traditional ownership companies and partnership companies used to have. दो भाई पार्टनर है या बाप बेटा पार्टनर है, दो फ्रेंड्स पार्टनर है, तीन फ्रेंड्स पार्टनर, वो चला गया, कम होता है, छोटा छोटा शॉप में होता है. आजकल है कॉर्पोरेट वर्ल्ड. That's where finance came into existence. Finance never existed, the word, before the corporate world was created. And the corporate world was created by basically limited liability companies, LTD, either private limited or public limited. You probably know that. If you are learning industrial economics, you have an industrial economics course this semester, so you would learn all that. I don't have to teach. So the finance came where you have heard of words like shares, debentures, etc. It's something different from credit. Credit is a loan, basically. You give a loan to somebody, create a debt, and you get a fixed interest payment against it, and you are supposed to return the money. Shares are very different. You buy a share, the company may not return the money to you for 15 years, 20 years. Now what to do? No problem. You go to the secondary market. When you go to the secondary market, like a stock exchange, you sell the share. So you have a secondary market to sell it off. And shares, when you buy them, you get an annual return called dividends. And sometimes dividends are not a compulsory obligation on part of companies to give to you. If company makes good profit, then they will share that part of the profit with you as dividend. If company doesn't make good profit, it will not share that. But there are various kinds of shares. There are preference shares where dividend has to be paid. But still companies can skip dividend for 1 or 2 years and pay a backlog. But in normal shares called equity shares, ordinary shares, dividend is not compulsory. But if the company makes good profit, you get a good dividend. But the preference shares are, even if a company makes good profit or a company makes a bad profit, you get the same dividend. So it's you to judge. I mean, it's up to you to judge whether you want to buy a preference share or an ordinary share. So it goes into that. But companies have a debt structure, debt, credit, etc., called debentures, where it's something like a loan. You buy a debenture, it's like a bond. A fixed interest return will be given to you by the company. So many people wish to buy debentures because it doesn't depend upon company profit. It's part of the company cost. The company will have to make that interest payment to you. It's not part of, not linked to profits, and then it can fluctuate. So many people prefer to buy, when they invest in corporate companies, buy debentures, because buying a debenture connects you with a fixed interest payment, like a bond. You know bond from the previous topic, the first topic. Various kinds of bonds are there. You have any question on this, what I've said so far? Anything to ask me? Nothing. Okay. So this money and credit and finance all has to do with money. And why money, I would explain that to you. Why money market has so much of importance of money. Shares, dividends, loans, I understand. Where is the money coming from? And coming to that, that's where macro policy is important, that part. So this what the financial system does, and what I will do, I will primarily concentrate on the first two, money and credit. And later, when you go to upper level courses, you can study finance. All right? Okay. Now, these three items, although related to each other, would differ from each other. So money refers to these medium of exchange or means of payment. Credit is a loan to be returned with interest. Finance is either debt finance obtained through sale of bonds and debentures, and then there are three types of ownership finances, namely equity finance obtained through sale of shares, retained earnings of a corporate company, and the own finances of the owners of a company, partnership company or joint company. Finances have three types. One is the equity finance, share finance, and also corporate companies have debt finance. So, they overlap, credit and finance overlap there. Credit is like a debt, loan, उधार जिसको कहते हो. Company का भी ऐसा लेते हैं उधार through debentures. Then the main finance that interests people like you is the equity finance. Share market में सर क्या होता है? अभी भी एक project कर रहा है एक 598 student आए थे कल. He is trying to look into the relationship between exchange rates and share market prices, secondary market prices. MSc student का 5th year में एक project है. So, this is what interests you, and of course, there are two other kinds of finances. Remember, retained earnings of a corporate company, which is undivided, undistributed profit, which is like a savings of a corporate company, undistributed profit. The profit hasn't been distributed to the shareholders. Profits have three conceptual parts, corporate profits. First part goes as taxes to the government, like my income. First thing it goes to taxes, then I have my income, which I take home. Next part is the dividend income. Last is whatever remains, residue is the retained earnings. Three parts are there. So, retained earnings, and of course, you have own finances. I am going to open a shop. The other day a fellow was telling me he and his wife trying to open an electric shop. ऐसे क्यों? तो क्या उसी लिए तो सर ये जमा रहा हूँ, आप लोग देंगे नहीं, कैसे मेरा दुकान खुलेगा? Own finances he was talking about. Not having something. Bank is not giving him a credit. He is a small businessman. So, what he is trying to do, he is not a private limited, public limited company, he cannot go to Bombay stock market or some other stock market or whatever, sell shares. So, what he is trying to do is utilize his own finances, whatever savings he has. So, that can be another source of finance. Okay. Now, before I go further, I would show only one slide from this topic today, and that will be enough for today's class. Then we will meet on Monday. Here, this is the standard, and this is Indian financial system diagram. Under Indian financial system, what you have three groups, you can say: financial institutions, financial markets, and financial instruments. I will talk about that later. That is where my focus will be, financial instruments. Like when you are exchanging something between a deficit unit and a surplus unit, there has to be an instrument through which you do. There has to be an institution, and the institution uses an instrument. It may be using mutual fund to transfer the money, it may be using shares, it may be using debentures, it may be using loan kind of a system, credit system, various kinds of systems. So, I need to talk about that, just not institutions. So, you have institutions operating in specific markets with specific financial instruments. That is exactly what happens, nothing, no big deal, all right. Like a vegetable seller selling something, he is operating either individually on part of somebody in a particular market and selling with a particular set of items. Simple. Now, financial markets, there are two types, as I told you, money and capital market, and both these money and capital market in India, particularly money market, not so much of capital market, has both an organized sector and an unorganized sector. Organized sector कौन है? Organized sector, I will go into the definition of these things. Organized sector is primarily which say is recognized by RBI in India in money market. In case of capital market, the organized sector will be which will be recognized by the Securities and Exchange Board of India, SEBI जिसको कहते हैं हम लोग, Learn these abbreviations, they are very important. SEBI headquarters is in Bombay, which is also known as the financial capital of India. Securities and Exchange Board of India, all these things are there, institutions, every descriptions are there in that book. That is like a dictionary, Professor Bole's book, you can use that. All these things are there in Professor Bole's book. You can buy even 350 rupees, 400 rupees you pay to buy a lifelong asset. It has a dictionary like thing. You can go to Noble, order Bole's book. There is a co-author, one of his students is now co-authoring because he is too old to edit it. He has retired, and he has one of his students is co-authoring and does the editing every year. Reprint aate hai jab. Or you can order a book. Everything is written. What is SEBI? When was it founded? What kind of an organization structure it has? Everything it says. What it does, functions are. So you don't have to go to Google search. You can have it in your room with you, like a dictionary we carry. Na? You can go to Google and find out in Wikipedia or whatever dictionary, if whichever is more comfortable. You can keep Professor Bole's book with you, only 400 rupees or something. Foreign authored books are very expensive, 5,000, 6,000, 7,000 it goes, but these are very inexpensive. Then it has an organized sector which is recognized, which pays taxes regularly to the government, which kind of files an income tax return, which submits its balance sheet to proper authorities as to what the expenses have been, the asset liability position, profit and loss account. That is more organized sector. लेकिन आप ठेला वाला ले लीजिए जो सब्जी बेच रहा है कि IIT कानपुर गेट में एक चाय वाला है, ये फल वाला है, ये सब अनऑर्गेनाइज. तो कैपिटल मनी मार्केट में उतना नहीं, मनी मार्केट में अनऑर्गेनाइज सेक्टर भी है जिधर में कोई अकाउंट मेंटेन नहीं होता है. नोबडी कीप्स एन अकाउंट, नोबडी रेगुलेट्स इट, दे डोंट पे टैक्सेस. इवन इफ दे पे अ लमसम टैक्स एड हॉक. कोई इनकम टैक्स अथॉरिटी आके कुछ चालान लगा देते, इतना टैक्स आपको देना है अंदाज से. There is no cash memo that you will get. Even shops don't give us cash memo. If you go to rave, I have seen you get a cash memo. Even though in market people don't give me cash memos. Old markets of Kanpur. To forget about these shops. Even institutions within IIT, go to Mahish store or any store or these places where you regularly transact, buy things, they don't give cash flow. We don't have a habit even. So that's why people say in India, unorganized market is huge, massive, more than the white market. Achha. So the unorganized market you have, particularly in money market and the organized market, which is under the regulation of an authority. In money market, the organized market regulator is whom? Boss, big boss, money market ka? Reserve Bank of India. And with respect to capital market, the SEBI. Remember that. Then all these markets have a primary and a secondary section. Most of these markets. Some of them are more developed than the others, but most of them have a primary and a secondary section. Primarily is when you are first time going into the transaction. New shares are being sold, which are called IPOs by companies, initial public offer, IPO. Learn these languages, terminologies. I know very little, so whatever I know, I am giving it to you. You will learn much more later. So IPOs, when companies go for IPOs, initial public offer, they advertise in the newspaper, etc., and they go for a public offer. If it is a public limited company. In a private limited company, they won't go to the newspaper because it's private, it's a private affair. Only 15, 16, 18 people are involved in the company, management, ownership. Shares are bought, all shares are bought by them. In a public limited company, there are millions of shareholders, depending upon the size of the company, how much shares they have sold. So that's the primary market. But once the shares have been sold, then you get into the mood, you have a bad mood suppose, and you don't want to sell, you don't want to keep the share. What will you do? You can go to the secondary market and sell it off. So initial you bought and then it goes to him. The same thing happens with some kind of debentures or bonds, debt instruments, same thing. Bond has a 5-year period, 10-year period maturity, longevity of the bond, but you don't want to sell it off after 3 years. In case of mutual fund also you can go to a secondary market, but the secondary market is limited to the company itself buys it. Suppose you have bought a mutual fund from UTI, it has a lock-in period for 3 years and then you want to sell it, it does not have a secondary market, the secondary market is very limited. What happens is the company buys it back. So, it is a transaction with the company again, but a proper secondary market, what happens is the ownership hand keeps on changing. So, a share in its lifetime till the company has called back all those shares, a lifetime may be 20 years, 25 years, 15 years, who knows, 50 years, 30 years, lifetime of a share, oh God knows how many times it changes hand. There are very few shares where the initial shareholder remains with the share. The other day there was a news, very interesting news, small news items are there. When Facebook started, there were a few shareholders only. So, one of the persons who bought the shares is a millionaire now, a billionaire maybe. Suddenly he decided to sell off all his Facebook shares, maybe he wants to do something new, and an amount, abnormal amount has come, unbelievable amount, how much money he made by selling that off, because the prices have gone up in the secondary market, prices have gone up, so whoever buy Facebook gives a huge dividend. So, the Facebook shares when he sold them off, how many units he had I do not know, maybe 5%, 10%, 20% of the total shares initial, he made about $60 million or something just from one transaction, selling off the Facebook shares, initial investor of Facebook when Facebook started. It was just a news item. So, how do make money? See, this is a typical speculative gain. What they do is that they buy a share when the company does well, they sell it off because the market price goes up. Simple market price reason going up is the demand supply relationship. The demand for those companies' shares go up. So, because they give a rich dividend and they have a good history, good financial standing, people trust them, so they want to buy them. So, a share face value is $10, maybe selling in the market at $50, $60, $100. An Indian share which has 10 rupee face value, selling into the market at 250 rupees, 300 rupees, 350 rupees. So, whenever there is an initial public offer, you watch out for the news. Some company is selling 1 lakh share, 2 lakh share, sell किया initial public offer 10 lakhs. ठीक है? Every share has a face value of 10 rupees, but then you hear the news, it has been sold at 250 rupees per share. So, people are willing to buy somebody whose face value is 10 at 253 rupees, because they expect to make a huge amount of dividend gain over the course of the life of the share. That is why they buy them. So, the company benefits, imagine, by selling 10 rupee share, it goes back to its bank and deposits 250 rupees per share. So, 3 types of ownership finances, namely equity finance, obtained through sale of shares, etc., that happens. So, you have the primary and the secondary market. Now, I come to the last, which I will touch upon a little bit, financial institutions. There are 4 kinds of financial institutions there: intermediary, non-intermediary, regulatory and other. Intermediary is who intermediates between the savers and the investors, which means the surplus spending units and the deficit spending units. It intermediates. Can you give an example of intermediary? Banks. But banks are not the only intermediaries in a country like India. There are also non-banks who act as intermediaries. You wonder, sir, how do they act as non-banks? How do they intermediate between savers and investors? Non-banks कैसे करते हैं? Well, they can simply sell bonds, collect the surplus of the economy from the savers and then invest in companies who needs them. We all know about ICICI bond, IDBI bond and all that, even mutual funds. and I hope you know mutual funds, what they are. You know the mutual fund business? Anybody has a problem with mutual funds? I am using that as an example often. They are not shares, they are not bonds, they are very peculiar kind of thing. Have you heard of mutual funds? Famous companies in India like UTI, and every bank or non-bank nearly has a mutual fund scheme. SBI famous mutual fund was SBI Magnum. Then you have these other mutual fund schemes from other companies, either banks or non-banks. Do you know mutual fund? Everybody knows it. Okay. If you don't know, raise your hand. You don't know exactly. Okay. Mutual funds are meant for small savers, first of all, who has little money to save. So, instead of giving the money to a savings account in a bank or a post office, they can buy mutual funds. They are like share certificates. Every mutual fund like UTI units have a face value, 100 rupees, 10 rupees, 200 rupees, whatever. So, when you buy a mutual fund, you buy not like shares, it has a premium, you buy exactly at the cost price, the face value price. So, suppose 100 rupees the unit value and you buy 10 mutual fund certificates. How much money you put in? 100 into 10, 1000. You are a small saver, 1000. UTI say, "ठीक है, 1000 invest करिए." Now, what it does after carrying this money, it goes back and pools all that mutual fund money that it has collected by selling. Somebody bought 10 units, somebody bought 100 units, somebody may have bought 1 lakh units. So, 1 lakh into 10, 10 lakhs is a big saver, not a small saver, maybe a big saver. What it does, then it takes the pool, and this is called, what they call that, this is a, there is a word, there is an expression for that. Then they look into the debt and the equity market, how the prices are, which they have been studying throughout, which prices are going up, which companies are doing well, which companies are not doing well. So, they make a kind of a fractional investment in the equity market, debt market consisting of various companies. Now, these debt markets, equity markets give them, debt market will give them a promised return on that money to the mutual fund company. And the equity market, of course, is equity linked, uncertainty is there. If the company does well, then they get a good dividend. So, depending upon how much return comes, total return, both from the debt market and the equity market, mutual fund company then announces a return per unit to these investors. So, instead of you going to the stock market and finding out where to invest the money, 1000 rupees, mutual fund companies do that on your behalf. So, often if units, UTI units, etc., you will find the language is written. If you buy a UTI unit tomorrow, it will say equity linked. That means it is connected to the share market, the investment you are going to do. But what they do, they, instead of not giving them a zero return or negative return, UTI, etc., mutual funds put part of the money in the debt market, where there is a promised return. Unless the company is liquidated, then I do not know what happens. And a part they put into the equity market. And also they go into the government bonds market, where it is also promised return. They can go there, they can invest in government bonds also, long term bonds, which are called dated government securities. Long term government bonds called dated government securities, they can also invest there. So, this is the game they play, simple. And in the process, what they do, they make some profit probably for themselves, and when the return comes at the end of a financial year, the money that is distributed back like a dividend to unit holders, mutual fund holders, like a dividend, it is like whatever income they make, they, of course, from the gross income, they deduct the administrative costs of running the company. There are people hired, there are non-personnel costs, overhead costs, electricity bills, AC bills, whatever, they get a net return value, then they distribute that. All right. So, you have the intermediary institutions. Then you have non-intermediary, you do not go to market at all. So, how do they carry out this helping out the deficit units? They do not go to the savers at all. Well, they have usually a source of funds from these big institutions. Big institutions may be like the RBI, the World Bank, Asian Development Bank, Government of India, or RBI subsidiaries like IDBI, or IDBI subsidiaries like SIDBI, SIDBI. They are all subsidiaries of one another. RBI founded IDBI. After IDBI was founded, IDBI founded SIDBI. Then SIDBI founded God knows how many institutions. This is going on. So, SIDBI goes to the market? No. Non-intermediate institutions, famous ones in India like IDBI and SIDBI. But the distinction is getting blurred a little bit. So, where do they have the money from? And the IDBI says we invest large scale industrial development. My goodness, large scale industrial development में जितना रुपया लगते हैं, iron and steel plant, fertilizer plant, chemical plants, machineries, massive amount of investments. Where do they get the money from? Banks cannot give them. So, this is how it is done. They get non-market sources they have. So, I will talk about that a little bit if I find time. Non-intermediaries, they do not intermediate, they do not come to you and me. But it is getting blurred because IDBI also sells bonds a little bit. They were famous in the mid 90s, IDBI Flexi Bond they were called. You were very young then, you won't remember. IDBI Flexi Bond, it became popular, very popular. I do not know whether they still have it or not. Some flexibility is there, I do not know what flexibility, but it is called IDBI Flexi Bond. Then you have regulatory institutions. Regulatory institutions I have already said, RBI and SEBI etc., two primary regulatory institutions that I will talk about. I will talk about only RBI a little bit, and often there are some regulatory institutions that are developing who does regulation on behalf of the mother organization like RBI. They divested the responsibility to, like I cannot teach this entire class. So, I call my tutor and say part of this class like the tutorials etc., you conduct. The RBI and institutions do that, they often do that. And you have other institutions, they are very fascinating, they are fantastic variety of other institutions. Most famous of them are the credit rating agencies. I will talk about that later. Other institutions, credit rating agencies. Credit rating agencies are names are like CRISIL etc., CRISIL, abbreviation C, capital R, capital I, capital S, capital I, capital L, CRISIL. Credit rate means is very interesting. It is like a doctor. When you are ill, you go to the doctor and get a health certificate. He takes your pulse, he takes your blood, does pathological tests and gives a report. A company may be asked to go get the credit rating done. Basically, it will examine the financial health of the company and it will give a grade, like you get a grade at IIT Kanpur, A plus, and their grades are like AAA, AA, BBB. Open foreign news channels, they talk about credit rating of European organizations done by credit rating agencies and how they are being downgraded. They talk about these days downgrading. That means it was a AAA institution, now it is only a BBB institution. Downgraded them. That means its financial health, however it examines, it is an enormous work, number crunching and all that, and comes up with a grade for a company. And I will tell you why these other organizations like credit rating organizations is important, because often regulatory organizations like RBI tells or SEBI tells a company, oh, you want to sell shares, IPO, get a credit rating done, come back with that report. Like you are going to join army, okay, get a health checkup done, then I will give you permission to join the army. You know, in army there is a compulsory health checking, that kind of a thing. So, often the regulation part involves those activities which have developed these other organizations like credit rating agencies, CRISIL etc. This is the basic kind of the summing up or the kind of summary of the financial system in India. Now, I need to talk about more, of course, this whole topic is on that, but I hope you have been following me on this part.